Has anyone been profitable year to year selling strangles before earnings? I feel the market is efficiently priced that you'll break even at best over time. It has been my experience with pretty much any earnings strategy that earnings trades are perfectly priced. You can sell all the options you want. In the end, I think you'll break even. And because you'll break even on the short side, you can buy all the options you want. If you want to play long option strategies, buying options, you're going to break even over time. Earnings are tough. It doesn't seem like you have much of an edge. For me, I like playing them on occasion on stocks that I want to follow, just to follow along with the market for engagement. That way I remember what Microsoft did for earnings this past quarter because I played it that one time for earnings, But as far as would that be like the only thing I do? Me personally, no. There are some traders out there that all they do is earnings trades. That's their strategy. For me, I think that's a tough thing. I can't do it. As far as selling strangles in earnings too, I sell a lot of strangles, but selling strangles on individual companies that are reporting earnings that day, man, you have got to have a very strong constitution. You've got to have some balls, because some of those strangles are going to get absolutely blown out. You're going to have stocks occasionally that make a 40, 50, 60% move up or down. Sometimes you have stocks that make crazy moves, and your strangle is going to lose in a big way. You might sell a strangle for a couple bucks premium, and then if you get the crazy move, which will happen, you'll have one or two a year that make some weird move, and you'll be down 10 grand. The strangle, right? Can you handle that on occasion? For me, I'd rather not deal with that. For me these days, I like trading a lot more ETFs than individual stocks. When it comes to, actually, if you just take a look at my portfolio right now, I got filled in the Apple trade, still waiting on SLV. I don't know if I'll get filled in this, but assuming I do get filled in SLV, if you take a look at the tickers that I have, MES, obviously, is a futures product. Apple's a stock, AVGO is a stock, Delta's a stock, FCX is a stock, and then that's an ETF, that's a stock, that's an ETF, that's a stock, that's a stock, ETF, long shares, ETF that mirrors the futures, ETF, Tesla's a stock, VIX is an index product, XBI, ETF, XHB, ETF, XLE, ETF, XSP, index. Yeah, most of the stuff I trade is not individual companies. And I would say that's been typical for me here in the last year or two. I just do a lot more with futures and ETFs than individual stocks. I find them safer, just because you don't have as much outlier moves in them when you're dealing with a basket of stocks rather than just one stock. Like this Apple event, it's going to move Apple in a big way, potentially. But if I'm trading like the entire tech sector, maybe the sector ETF like XLK or the Qs, the entire NASDAQ, I don't have to worry what Apple does. Yeah, Apple's going to affect those products, but it's not going to affect it the same way as if I was, just straight a naked put or naked strangle in Apple itself. I just don't take as much risk these days, I guess. I used to trade nothing but stocks, thought the ETFs were boring. Now I've kind of gravitated the other way. I kind of like the boring ETFs. Let's start with Newmont Mining, because that's the one earnings trade that I thought, I don't mind taking. IV rank at 80, IVX 37%. Gold mining companies, by the way, typically don't have high volatility. It's not a tech company, but still, that's pretty good IV. This thing had a really rough patch at the end of last year, which I was caught up in some of this. And that was part of why I got assigned on GDX at one point. A huge sell-off in the gold mining companies, but they've rallied nicely since the start of this year. I have no real directional bias, but you never want to step in. I often talk about don't step in front of a train, right? If it just looks like it wants to go up, this might be one just to sell some puts on. Liquidity in this April cycle isn't great as far as some wide bid-ask spreads. Since it's an earnings trade, I could go out a little further, maybe like a 10 delta put. Maybe also sell like a 10 delta call. It's not a 10 delta call, like a 7 delta call. Man, that's really wide. That's not taking very much risk at all, but 58 cents credit versus $476 buying power. I guess I could do a strangle. Do a couple contracts, maybe 3 contracts. $174 max profit on $1,400 buying power. You know what? That's a little bit too much of a wuss kind of trade. Let's bring that into the 17 delta on each side. 18 delta put, 17 delta call. 132 credit on a buying power of 490. Yeah, that's much better. Maybe sell 2 contracts of that. So 262 credit on a buying power reduction of $1,000. Don't know where Newmont's going, but it's not a terribly high price stock. So if it got completely killed on the put side, I don't hate the idea of just taking shares. I could run the wheel on it. The upside is a little bit more of a problem, but on the upside, I just take the loss, right? At the end of the day, you know, I'm sold that for what, 260 or so. If I get the kind of non-move that I want, plus volatility comes in, I might make a buck on this tomorrow. Might make a quick $100 in one day. Or if it makes a crazy move against me, I may lose a couple of bucks. I may lose a couple $100 tomorrow and just close the trade. Let's see what else. Some things I haven't traded lately. I'm not in a lot of the semiconductors. You guys remember most of 2024. I was pretty much all in on the semiconductors. I always had positions in NVIDIA and AMD, especially those two. But also I traded a lot of Micron. I traded a lot of Qualcomm. Broadcom. I do have a Broadcom position right now. But let's check AMD. IV rank of only 9. So that's not great for me going and selling options. But what I could do, nothing saying I couldn't go buy some long premium, you know, you just go buy some options. Maybe do a poor man's covered call. Buy the 75 delta call at 56 days. And then the 29-day cycle, let's go sell a call, something around the 30 delta, maybe. How about the 26 delta? Receive about a $1.90 credit on that. So overall, my debit would be $11.75. I'd pay $1,100 for this poor man's cover call. Poor man's cover call is essentially a let me zoom out. It's essentially a call debit spread, but it's diagonalized, right? Because the long call's further out in time. The short call, less further out in time, you know, it's closer in. What this means is the long call has a little bit more juice. It has a little bit more punch to the trade. And this is definitely a bullish trade. You want it to go up. If it goes up, you win. If it goes down, you lose. Realistically, you know, if I get a move of $5 or $10 up over the next few days, I'd make probably $300, $400, maybe $500, you know, but probably $300 or $400 is kind of like the profit I'd take on the trade. If I get the move not right and it makes a move down $5 to $10, I'm going to lose probably $300, $400, $500 on the trade. Max loss would, on a debit trade, your max loss is always what you pay. So my max loss would be the $11.60 or whatever I pay for the trade, but you're not going to realize a max loss. The only way to realize a max loss on this would be to hold it to expiration and then just let this thing expire worthless, which I would never do. That's not what we do here, right? And the max profit, there's no real max profit on the trade on a diagonal because it's kind of fuzzy because your options are not in the same cycle. So it's hard for, you know, it's really impossible to calculate, but your max profit on the trade is probably somewhere in the neighborhood of $800 or so. But again, you're not going to ever realize a max profit unless you hold to expiration and you got a huge move up, which again, not recommended to hold to expiration. In this case, I'm basically going to try to make $300 or $400, and I'm risking probably about $400 or $500 on the downside. Let's put that in. But General Motors, it's another ticker I haven't traded lately. Has it had earnings? No, yeah, it has. It's got a dividend coming up, but that shouldn't affect us. IV rank of 35, IVX of 34%. What has this stock done lately? Not really much. This might be one to sell a strangle in if I could get a decent price. Let's go 15 delta, put 13 delta call. It's the 42 and 55. 86-cent credit. Buying power reduction of 476. I like that. Let's sell 2 contracts of this. 172 credit. Buying power reduction of $1,000. I'm going to go with it. There we go. 3 new trades on, assuming I get filled on that. Yeah, typically though, if you're putting on these trades, especially, the risky trades or your short options trades, if you're putting them on out of the money, and you're putting them on with at least some time to them, I typically go about 60 DTE, for a new trade I'm first putting on. Usually those things, they've got so much time on them. You've got time to wait it out. And it's never as bad. Like if you put on a trade at 30 DTE, it's a lot less time on those. And when they start going against you, they hurt more and there's less you can do as far as trying to defend them, trying to roll them. But when you're out at 60 DTE or like my MES trades, I put them on at 90 DTE because I fear those a lot more. So I give myself an even extra month on those, 3 months on those. That's a lot of time. So when the market, say, like if the ES was down $150 today, my MES puts are going to get killed. But I've got 3 more months to wait it out and see if they turn around, right? So the more time, the more flexibility you have in your trading. But as long as you're trading small, you're trading those short options out of the money a little bit, at least 30 deltas, if not 20 deltas, 10 deltas. You can give yourself a little cushion to be wrong on direction and give yourself, 2 months on the trade. Give yourself 60 DTE on the trade. You're not really going to run into too many bad losers. You'll run into the occasional bad loser, but they'll, I would say I make about 2,500 trades a year, and there's probably 2 to 3 trades every year that I can look back on and go, man, that was ugly. So on average, say 1 out of every 1,000 trades I make is one that's like, well, that was nasty. But when you think about it that in those terms, it's not that many. And those nasty trades, the good ones, the 999 good trades, more than made up for the 1 bad trade. James, how soon do you cut a loser? Is it % of account balance per trade? So that's the way, most people will think about it, is have a percentage that, hey, once I hit this, that's my stop loss. If you want to do a stop loss, have a mental stop loss. A lot of people, they do something around a 2x or a 3x loss, meaning if I sell an option for $1, if I'm taking a 2x stop loss, then if I'm down $200 at one point on that trade, I'll just cut my losses at that point, or 3x stop loss. If I'm down $300 on the trade at that point, that's when I'll cut my losses. Now that's kind of how I do it. I don't hold to that hard and fast because sometimes I'll be down on something. If I want the shares, I'll just take the shares. It'll be different when you're wheeling something, but if you don't want shares at all, and if there's no weird volatility spikes going on, like, back on August 5th, I mean, if I was holding to stop losses, I would have closed every position I had and I would have realized like a $20,000 loss that day. I didn't, right? Because I knew those weren't real losses. So, I mean, you'll have to play with it a little bit, but for the most part, I would say the way I think about it is if I get down, like a 3x loss, then I'm usually going to close the trade unless I want the shares. So some of those strangles I just sold, say one of those strangles I think I sold for $2. If I wake up one day, I'm down $600 on the position, I'll probably close the trade. Unless I'm losing on the downside, on the put side, and I'm like, well, I'll take the shares, then I'll just take the shares. Whatever it is, you should have some idea, though, on every trade, what the loss is that you're prepared to take. What you don't want to end up doing, and a lot of traders end up doing this, especially when you start trading, because you never really want to think about losses. Naturally, our tendency is to think about winning on every trade. It's all about the reward. We never think about the risk. So a lot of people end up in a situation where they're put on a trade. It goes badly against them. They'll be staring at a loss, and then they don't know what to do with it. So you do want to plan it out ahead of time. And if you just have a hard and fast rule, hey, at a 3x loss, I'm getting out. Boom, you ain't got to think about it, right? You already planned that ahead of time. When it hits that, it's like, you know what? That's as big a loss as I was prepared to take. I'm done.